Hello guys, today we going to talk about money and how it works. So if you like the videos, please subscribe to support the channel. Now, let's dive into it. Monetary system. A monetary system is a system by which a government provides money in a country's economy. Modern monetary systems usually consist of the national treasury, the mint, the central banks and commercial banks. Commodity money system. Commodity-backed money. One step away from commodity money is commodity-backed money, also known as representative money. Many currencies have consisted of bank-issued notes which have no inherent physical value, but which may be exchanged for a precious metal, such as gold. This is known as the gold standard. The silver standard was widespread after the fall of the Byzantine Empire, and lasted until 1935, when it was abandoned by China and Hong Kong. A 20th century variation was bimetallism, also called the double standard, under which both gold and silver were legal tender. Fiat money. Fiat money, from Latin, fiat, let it be done, is a type of currency that is not backed by any commodities such as gold or silver. It is typically declared by a decree from the government to be legal tender. Throughout history, fiat money was sometimes issued by local banks and other institutions. In modern times, fiat money is generally established by government regulation. Fiat money generally does not have intrinsic value and does not have use value. It has value only because the individuals who use it as a unit of account, or, in the case of currency, a medium of exchange, agree on its value. They trust that it will be accepted by merchants and other people. Government-issued fiat money banknotes were used first during the 11th century in China. Fiat money started to predominate during the 20th century. Since President Richard Nixon's decision to default on the US dollar convertibility to gold in 1971, a system of national fiat currencies has been used globally. The alternative to a commodity money system is fiat money, which is defined by a central bank and government law as legal tender even if it has no intrinsic value. Originally, fiat money was paper currency or base metal coinage, but in modern economies it mainly exists as data such as bank balances and records of credit or debit card purchases, and the fraction that exists as notes and coins is relatively small. Money is mostly created by banks when they loan to customers. Put simply, banks lending currency to customers, subject to each bank's regulatory limit, is the principal mode of new deposit creation. The central bank does not directly fix the amount of currency in circulation, nor is central bank money. Although commercial banks create circulating money via lending, they cannot do so freely without limit. Banks are limited in how much they can lend both by regulatory limits and by good management practice, in order to remain profitable and solvent. Prudential regulation also acts as a constraint on banks' activities in order to maintain the resilience of the financial system. And the households and companies who receive the money created by new lending may take actions that affect the stock of money. They could quickly destroy the money or currency by using it to repay their existing debt. For instance, central banks control the creation of money by commercial banks, by setting interest rates on reserves. This limits the amount of money the commercial banks are willing to lend, and thus create, as it affects the profitability of lending in a competitive market. This is the opposite of what many people believe about the creation of fiat money. The most common misconception was that central banks print all the money. This is not reflective of what actually happens. Today's global monetary system is essentially a fiat system because people can use paper bills or bank balances to buy goods. In monetary economics, fiat money is an intrinsically valueless object, or record that is accepted widely as a means of payment. Modern theories of money try to explain that the value of fiat money is greater than the value of its metal content. All these pieces of paper are issued with as much solemnity and authority, as if they were of pure gold or silver, and indeed everybody takes them readily. For wheresoever a person may find these pieces of paper current, and shall be able to transact all sales and purchases of goods by means of them, just as well as if they were coins of pure gold. An early form of fiat currency in the American colonies was bills of credit. Provincial governments produced notes which were fiat currency, with the promise to allow holders to pay taxes with those notes. The notes were issued to pay current obligations and could be used for taxes levied at a later time. Since the notes were denominated in the local unit of account, they were circulated from person to person in non-tax transactions. These types of notes were issued particularly in Pennsylvania, Virginia, and Massachusetts. Such money was sold at a discount of silver, which the government would then spend, and would expire at a fixed date later. After World War I, governments and banks generally still promised to convert notes and coins into their nominal commodity on demand, typically gold. However, the costs of the war and the required repairs and economic growth based on government borrowing afterward made governments suspend redemption by specie. Some governments were careful of avoiding sovereign default, but not wary of the consequences of paying debts by consigning newly printed cash, not associated with a metal standard to their creditors, which resulted in hyperinflation. A central bank introduces new money into an economy by purchasing financial assets, or lending money to financial institutions. Commercial banks then redeploy, or repurpose this base money by credit creation through fractional reserve banking, which expands the total supply of broad money cash plus demand deposits. The adoption of fiat currency by many countries, from the 18th century onwards, made much larger variations in the supply of money possible. Since then, huge increases in the supply of paper money have occurred in a number of countries, producing hyperinflations. Episodes of extreme inflation, rates much greater than those observed during earlier periods of commodity money. The hyperinflation in the Weimar Republic of Germany is a notable example. Economists generally believe that high rates of inflation and hyperinflation are caused by an excessive growth of the money supply. Presently, most economists favor a small and steady rate of inflation. Small inflation reduces the severity of economic recessions by enabling the labor market to adjust more quickly to a recession, and reduces the risk. A liquidity trap prevents monetary policy from stabilizing the economy. However, money supply growth does not always cause nominal increases of price. Money supply growth may instead result in stable prices at a time in which they would otherwise be decreasing. Some economists maintain that with the conditions of a liquidity trap, large monetary injections are like pushing on a string. The task of keeping the rate of inflation small and stable is usually given to monetary authorities. Generally, these monetary authorities are the national banks, that control monetary policy by the setting of interest rates, by open market operations, and by the setting of banking reserve requirements. So, the question is, why do human beings buy gold using representative of it? It just doesn't make sense. How can you buy an original thing using a fake one? The world is deceived. So, you tell us below on the comment section, what do you think about the monetary system? Don't forget to hit the subscribe button, notification bell. Share this knowledge with friends and family. Watch out for more eye-opening videos. From us LMG, we love you.